Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 280 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. Matt is traveling for business this week, so I'm joined once again by Nick Whitaker in our office for today's episode. So Nick, welcome back.
Yes, thank you. Good to be here. It's been a couple weeks.
It's been some time.
Yeah, since I've been on, so nice to be back. Hello to all the listeners.
Yeah, it's always a pleasure to have you on. So, as always, we will quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from Y-Charts and as of the market close on December 11th. S&P 500 index up 27.6% for the year. Up 0.9% for the month and 27.6% for the year. The Dow Jones Industrial Average down 1.7% for December and up 17.1% for the year. The NASDAQ Composite Index up 4.2% for the month and up 33.5% for the year. The Russell 2000 Small Cap Index down 1.7% for December, but up 18.5% on the year. And the Vanguard All World X United States ETF up 1.2% for the month and up 8% for the year. 3-month Treasury rate at 4.38%, the 2-year Treasury rate at 4.15%, and the 10-year Treasury rate at 4.26%. Moving on to headlines, current events from the past week, Nick. We got a CPI print, the most recent one, yesterday on December 11th. So total CPI, or the Consumer Price Index, was up 0.3% month over month in November, as expected, leaving the year-over-year rate up 2.7% versus 2.6% in October. Core CPI, which excludes food and energy, was up 0.3% month over month, which was expected, leaving the year-over-year core CPI rate up 3.3%, which was unchanged from October. So the market reacted slightly favorably for a couple of reasons, Nick. Number one, the first is that the report wasn't worse than feared. It was kind of right in line with expectations, so it didn't really upset the market's view or change any probabilities of what the Fed is going to do next week at their meeting. It's widely anticipated that they will cut by 0.25% or 25 basis points. Second key takeaway is that the breakdown of the shelter index included the smallest increases for rent since April of 2021. So we've talked before about how shelter is a very, very much lagging indicator or input going into CPI. So with shelter and rent continuing to come down, that should really, over the next several months and into 2025, really help with inflation as long as other areas don't spike.
Yeah, it should continue to pull down on the core piece there.
Right.
Just so when you're looking at all the little pieces together. Yeah.
Correct. So that's all we have for big headlines, current events. Moving on to tweets, articles, and research from this week. First thing I had was a tweet from Nick Gurley on December 6th, and this data is from the U.S. Census Bureau. So Jenna will share these two charts with listeners on the YouTube page. They'll also be in our show notes, but the first tweet that Nick had, he said, home builders now have the second highest level of homes for sale on record. Mid-2000s housing bubble was only time inventory was higher. We're now within 19% of that peak. So kind of going back to the housing conversation we just had, Nick, people for so many years have been waiting for affordable housing, right, and rates to come down. And one of the issues that has been a problem in the U.S. economy is there just hasn't been enough housing, right? So inventory is creeping up and up and up. And this chart shows new for sale completed homes and then new homes that are under construction as well. So we are at pretty high levels, levels that we haven't seen since 2008 in terms of homes for sale. So obviously this eventually should have an impact on prices. I don't think this is a timing indicator because, we have had relatively high supply to history for the past couple of years and housing prices still haven't come down. The second chart and tweet that Nick had was about new homes for sale specifically in the South. So he says another implication from this graph is that the housing market in the South could be in for a reckoning in 2025. And it's the South where builders have, over 60% of their homes of sale. Building in the Midwest and Northeast is basically non-existent, but in the South, it's everywhere. Note this graph is not comparable to the first one, as this one includes houses not yet started in sale count. So this has been a narrative for a while, I feel like, Nick, that especially like in Florida, that there's new homes for sale all over the place. There's new construction all over the place. Now, I'm not necessarily in the same camp as Nick that I think there's going to be a reckoning in 2025. I mean, there very well could be, but we're not in the predictions industry. But thought this was really interesting because when you think of a state like Florida, you almost are like where else can they build? Because there's so many people in Florida and there's so many houses in Florida. So I think it's going to be at least an interesting next couple of years for the housing market, specifically in the South. And specifically because of all the natural disasters that have been happening, in the Carolinas and in Florida, I personally think, just a fun prediction that I have, that there's going to be this remigration specifically to the Midwest or to the rest of the country from states like Florida and the Carolinas if we continue to have these really bad hurricanes, right? Because it's going to be unaffordable to live there. And then you're going to have the issue of, being stuck with all of this housing inventory in Florida when people are migrating or moving out of Florida instead of moving to Florida. So this could be, an interesting decade for housing, especially in the state of Florida, but just in the southern states in general.
Yeah, I think, first off, I love both of these charts. I think they're really good charts. They kind of show a good picture, and I love a historical chart. On the second chart, looking at the South and thinking about that, I'm from North Carolina, so I have some natural bias in there because North Carolina is considered the South, and I saw that through most of my adulthood and even youth in a lot of ways, where I grew up an hour north of Charlotte, and I lived in Charlotte for about 1.5 years, 2 years, and most people you met in Charlotte are from the north, and so there's a lot of migration, and that's one of the things that pushes up home prices in the South and the Southeast, and the reason is you can get more bang for your buck. So you see it with Florida and state taxes, and Texas, you see the same thing. So that's kind of the narrative and why that chart looks the way it is. There's more land, and the weather's a little bit nicer year round anyway. So, and then you have people, and we know plenty of people who do this with the whole winter snowbirds, snowbird thing. So that's kind of the narrative behind that, and it's a great chart. We'll see. You would expect it based on history to kind of come down a little bit, but it'll be interesting.
Yeah, I just think with all of the current events going on in the world, and with the hurricanes and this housing supply that seems to be exploding, especially in Florida. I don't know if it's going to be something similar to 2008 or not, but I do think sometime within the next several years, there will be some pretty nice buying opportunities in terms of real estate down south and specifically in the Florida area. And I know that, people are always waiting for the next 2008, right? And it might not be to that magnitude, but I do think that there will be some pretty nice opportunities to buy some things at relatively cheap prices. So next thing I had was a blog post from Ben Carlson on November 14th titled, "Is the United States Going Broke?" And I think this is everyone's favorite topic, Nick, to talk about the U.S. government debt and what it means. It's definitely a conversation that has come up in family political conversations, at least in the McEvely family, with our extended family at least. And people are usually on one side or the other. There's a lot of things in our industry where there's not really a lot of middle ground, and this is another one of those. It's like the U.S. is going to go broke. We're done for. It's going to be a huge reckoning. They're going to fall. We're not going to be the most powerful country in the world. And then there's another camp that's like, it doesn't matter. We've been doing this for how many decades now, and it hasn't mattered. So I thought Ben had a pretty thoughtful post, so I wanted to read a majority of this post for listeners, but definitely encourage people to check out the entire thing. So a reader of Ben's asked him, how worried should we be about government debt levels? People like Paul Tudor Jones and Elon Musk keep talking about how we're going broke, but what is the catalyst for an actual crisis here? One view is that the government debt doesn't really matter all that much since we have the global reserve currency and the ability to print as much of that currency as we'd like. The other view is that the government debt levels are reaching a tipping point that will lead to a calamity. It is true that the U.S. government debt is enormous. Total government debt in the United States was around $23 trillion heading into the pandemic, so debt levels are up 50% or so this decade alone, currently sitting at about $35 trillion. It's also true that interest rates we pay on government debt has risen considerably since we've taken on so much, and interest rates are so much higher than they were in the 2010s. So Jenna's going to share this next chart, which is a breakdown from JP Morgan that shows the federal budget and where money is being spent by the government. So this is a really nice, concise, transparent chart. Would encourage people to check this out. And some of the interesting things that I pulled from this is that interest expense makes up roughly the same amount as defense spending right now, which is kind of crazy. Entitlements, which are Social Security, Medicare, and Medicaid, still make up most of the federal budget, which is around 46%. But interest expense is getting up there. But Ben says you can't look at debt levels on their own. You have to think of them through the lens of a $30 trillion U.S. economy. Interest expense as a percentage of GDP is only 2.58%. Government spending as a percentage of GDP is lower than 25%, which is down from 45% during the pandemic and back to its long-term trend line. The thing you have to understand about the United States government is that it does not operate like a household when it comes to debt. You pay off your mortgage over time and eventually retire that debt. The government's budget is not at all like a household budget. First of all, the government can print its own currency. That helps in a pinch and is the main reason our government can't go broke. As long as the economy is growing, debt should be growing too. So I thought it was good. And my big takeaway from this is usually when we're looking at economic data, Nick, or market data, you always have to look at things relative to something else because as we know, over time, inflation makes, a dollar worth less and less. But you have to apply that to all these other metrics, right? Yes, debt is rising, but people are making more money. People have steadier jobs, so on and so forth.
The economy is healthy.
Right. The economy is healthy. The economy keeps growing. So, so I really think, my personal opinion is that that we're going to be totally fine. I don't think it's a situation where, the U.S. economy is no longer going to be the strongest economy in the world just because we have so much debt. there's a lot of things that the government can do or levers to pull, you know, to make this problem not as big of a problem.
Yeah.
And I think
there are options out there.
there
right?
are options out there. And if it was such a huge problem like right now or even within the next couple of years, I just don't think the market would be at an all-time high and be as strong as it has been, right?
Yeah. 100% agree on that.
So, yeah, really good article. Go check out that graphic from JP Morgan because it kind of does a really good job of breaking down the spending of government money. Thought that was worth discussing.
Yeah, I'll just throw one other thing for listeners to think about in the context of this debate is think about the U.S. economy and particularly the U.S. markets being the flight to safety in a lot of ways, our treasury bills being the flight to safety, not just for the U.S. economy and U.S. investors, but for the entire world.
Oh, yeah.
Right? And that's a big deal because let's say Armageddon does happen, right? Okay, well, there's going to have to be a new flight to safety. And where do you want to park your money?
Europe?
Japan? So even if, like, let's play the hypothetical what if, which is a terrible game to play, especially in this industry. But my personal opinion is even if something did happen and we defaulted on our debt one time, I think the forces of capitalism will reign on the government so hard that they will be forced to take action. Mm-hmm. There will be volatility. We will clean it up. Our government will clean some things up. We'll change the forecast of our debt. And then everything will go back to normal. Will there be volatility in the markets? Yes, of course. There will always be volatility in the markets. But I think worst case scenario, that's likely what will happen, where there'll be a big shakeup and then things kind of normalize. And I still don't think that will happen personally. Mm-hmm. But if it were to happen, I think that's the most likely path just because that whole flight to safety and our markets being the most trusted markets in the world. And it's been like that since the beginning of the markets.
Yeah, no, it was very well said. And, until people are not willing to invest in the U.S. anymore, things are just going to continue as is. Yeah. And I just don't see that happening anytime soon. So last thing I had was a quote from a famous investor, Nicholas Darvis. He said, "As for good stocks and bad stocks, there were no such things. There were only stocks increasing in price and stocks declining in price." And I think, Nick, people tend to fall in love with stocks and fall in love with the story behind a stock, even if the price goes against them or the performance for the stock has been horrible for the past couple of years. And I just think this is a simplistic way to determine if you should be buying or selling a given stock. And I also think it highlights the difference between a good company and a good stock, because I think those are two completely different things, right?
Absolutely.
And we've seen that play out time and time again in the market over and over again. So just wanted to share that with people. I thought it was a simple way. And my recommendation is never fall in love with any single stock, right? Because most people are like, hey, I bought it at X. It's fallen to Y. I'm just going to hold it until it gets back to X. And at that point, number one, it could possibly never get back to whatever price you bought it for. Number two, you have opportunity costs. So you're going to continue to take losses rather than having the opportunity to sell it and go buy something else and make your money back that way.
Absolutely.
So I always just tell people, don't fall in love with any one of your holdings, because then your emotional biases come into play, and that just creates a whole nother host of issues that we don't need to have.
Yeah. Yeah. It's a great quote and a great point. I kind of think of things differently. Like I think of there are companies and then there are stocks. Obviously the stock and the company sometimes those words can kind of mold together, but they're very two different things, right? There's the company and then there's the investment in the company, two separate things. And then there's the story behind the company, so those kind of three narratives, so to speak. And you can fall in love with the company or the story because of the historical bias or how it impacts your life. I won't name any names, but plenty come to mind. but that's different than the investment, and the stock is the investment.
Yeah,
So-
and I would say most of the time, when there's a well-known company that has well-known, highly utilized products, that translates to the stock performance. But there are times where there's a mismatch there. So
Absolutely.
just think that it's important to point that out.
Yep. Absolutely. I have 3 research pieces today that are all from the same research article from Charlie Bolello. And I was reading this the other day, and I thought they were great. And it's 7 lessons from 2024. I'm not going to go through all 7. I just picked a few of them. The whole article is great. I encourage listeners to check it out. His research is it's a pretty quick read, I think, in general.
And we'll link to that full article in the show notes.
We'll have a link, and it's very digestible, and there's lots of charts, and it's very like story arc driven. So it's an easy read. The first piece here is that price targets are pointless.
Preach it, Charlie.
Yeah, I was about to say, I know you'll love this one. Okay, so he says the following: at 6,090, the S&P 500 is now 690 points above the highest 2024 year-end price target from Wall Street strategists, and 25% above the average target, which was 48.61. The most bearish target came from JP Morgan, biggest bank in the world with access to some of the smartest minds and more data and information than anyone else. What did they foresee? Lackluster earnings growth at 2 to 3%, rising geopolitical risks, softening economic demand, and a price target of 4,200 with a downside bias. He takes a snippet of a JP Morgan research piece that says, as we approach 2024, we expect both inflation data and economic demand to soften as the tailwinds for growth and risk markets are fading. Overall, we are cautious on the performance of risky assets and the broader macro outlook over the next 6 months due to building monetary headwinds, geopolitical risk, and expensive asset valuations. That's a direct quote from JP Morgan research early in 2024. Back to Charlie's points. What actually transpired is earnings growth of 10%, stronger than expected economic growth, and a significant boost in investor optimism, which translated to a 17% multiple expansion. And then he has a chart here that shows that the current level is 25% above the target.
Yeah, this is a really good chart that I would want everybody to see. Again, it goes back to not listening to the quote unquote experts, some of the smartest people in the industry that have these price targets. And I don't blame them. A lot of these companies
job, right?
it's their job,
Yeah.
and they're, they have to come up with a price target. I just think the whole thing is just silly.
Yeah,
because since we've started this podcast, I think we've gone over this like every single year. We go over what the price targets have been for the year, and at the end of the year, we see what the performance of the S&P 500 is. And it's always so far off that it doesn't do any good. I mean, honestly, what is the benefit for you guessing what the price target of the S&P 500 is going to be at the end of any given year? It's not like you get like a prize for it. There's no award for it. So why are we doing it? Yeah, really, really, really nice chart. I like that a lot. So, definitely check that out.
As soon as I read that, I was like, oh, Mark's going to love this.
Oh my gosh. It's just year over year, it just does not disappoint.
Yeah.
Or does disappoint, but you get what I'm saying.
Oh, yeah. So the second piece is called Embrace Panic. Charlie says the following: on the morning of August 5th, panic was in the air. Japan's 225 index had just suffered its largest 2-day decline in history, minus 17.5%, even bigger than the October 1987 crash. Fear of the unwinding carry trade, and we talked about that in the podcast. If you want to learn about the carry trade, you can reference old podcasts. Fear of the unwinding carry trade spilled over into the U.S. markets, and the VIX spiked to over 65, its highest level since March of 2020. We know what happened in March of 2020. Mm-hmm. Investors who embraced this panic would soon be rewarded, with the S&P quickly recovering from its losses that day, and the S&P is now up over 19% from the panic lows on August 5th. Then there are two charts here that show the spike in the VIX, which is quite a notable spike, particularly in such a short span of a day or two, even when you compare it relative to COVID, which kind of took a couple days to spike up. Excuse me. And then he shows a chart of the S&P 500 total return index and kind of annotates it for us to show the change. So
yeah, I remember this day very well. I was in the car for most of the day driving home from visiting family, and as you can imagine, was pretty stressed the entire day. Not well. Number one, because we had our daughter in the car driving for 7 hours, and number two, the VIX spiked to the highest level in several years, and so I'm there driving, staying pretty quiet to myself, not very happy. And Kenzie was like, "What's the matter?" And I was like, "Well, I wish I was in the office. This, and this is going on." And she was like, "But what would you do differently, if you were there?" And I was like, "Huh, you're right. Yeah.
Probably
we're gonna stick to our game plan that we've had all year, and we wouldn't do anything differently." And that turned out to be a good idea. So, volatility presents amazing opportunity, especially for people with a long time horizon. I always say that younger people who have 401ks with their employers, especially people maybe 35 and under, should be begging for the market to drop so that they can buy in at lower prices, because they're buying in every 2 weeks or whenever they get their paycheck. So, it's a thing that can be scary and definitely is scary at times. But I think if you look at it through the lens of an opportunity, it could be a little less scary for people.
Yeah, going back to the quote you had from, what was his name? I'm blanking. Nicholas Darvis. They're investments, right? Mm-hmm. You're getting your investment at a cheaper price.
Right.
If you think of it like that, sometimes buying during the panic can help.
And it's funny because, whenever there's a sale, or let's take Black Friday or Cyber Monday, for example, because those just happen, people, flock to go take advantage of these sales. And this is where you see a lot of the e-commerce companies and a lot of the retail stores do their best sales all year, right? So when you're buying products, people love a good sale, right? But
they'll spend more money because of a good sale.
Right. But when stocks are down 20% or 30% off, people don't want to touch it. Right. So it's just, it's interesting to see the different psychological behavior when it comes to managing an investment portfolio when you have stocks on sale versus you actually going to spend money to get a sale on your favorite item or from your favorite, retail shop.
Yeah, I'm sure every listener out there can think of at least one person in their life or overheard a conversation where you hear someone say, "Oh, look at all the money I saved on this discount shopping or
right.
Amazon Prime Day. I saved 50%. It's well, technically you still spent the money."
Right. Yeah, exactly. And it's just one of those things where, I always see when I'm going through my research and on Twitter, everyone's like, if you loved XYZ stock at 300, then you should really, really love it at $50 a share. Right. So interesting, kind of works in reverse when you're talking about investment portfolios for people.
Absolutely. The last piece I have here is about tuning out the noise. So, and again, this is 7 lessons from 2024. So tune out the noise. Every day of every month of every year, there's noise. The media's job is to amplify that noise, getting the most views and clicks. The more noise, the better. That's their job. Any discussion of politics naturally generates strong emotions, and the media loves to play on these emotions to create additional drama. Entering 2024, we were told that presidential election years are bad for stocks. He has that in quotes. He has a couple screenshots of Google searches of those times where he has one from Barron's from 2023 and November 10th. So, leading into 2024, it says election years are bad for stocks. He has another one from Yahoo Finance on May 14th of 2024 that says why you should sell off stocks before the presidential election.
It's like out of control. Like, and Barron's is a respected like publication for markets and the economy.
And a lot of times Barron's has good stuff, but this just goes to show you about that. They
But
still
that's
have to
just
get
like
clicks.
that's flat out false. And we've shared the data on this podcast with listeners before about what typical election years tend to look like. And typical election years tend to be pretty average, doing anywhere between 7 and 10% per year per election year. I don't know about you, Nick, but I don't think that means election years are bad for stocks. Like that's just categorically false. And it's kind of scary that like this stuff is out there from a company like Barron's that, like you said, does have good stuff, but this is just, it's almost infuriating that stuff is out there. So you can't take, your first couple Google searches as biblical. In this day and age, you have to check your own research, check your sources, check the data, and not just rely on other people for things.
Yeah, go straight to the source if you can. And now these types of things are tough because there's no way you can go straight to the source on this. But that's why you have financial advisors. That's your source.
Yeah, I'm gonna read that article and see what it says, because I know that the data, they probably don't share any actual historical data in that article because it would completely contradict what they're saying. So
yeah, that'd be an interesting read. And then Charlie says, does the data support the notion that investors should avoid presidential election year?
Oh, perfect.
Not at all. Historically, U.S. stocks have actually outperformed during election years, 10% gain versus a 9.7% gain in non-election years. So basically the same, but
going back to
1928. With higher percentage of positive returns, 83% versus 69% in non-election years. So there's a little chart there that just shows the 10% versus the 9%. But we've talked about it all year long, like consistently for listeners, because we know the kinds of headlines that are out there and the volatility. I mean, this is our industry, so we understand what's going on. But that's why we bring it up so consistently, is because there's so much noise out there, and we know that the media is going to do their jobs. Unfortunately, they do a good job when you look at what their job is, which is to get clicks and to, stir things up. They do a good job with that. Hats off. I don't think it's good for people, but we know that's happening, and that's why we bring it up so much. So when people are like, "Oh, they're talking about it again," it's like, well, this is why. So
you know how they have like fact checking websites for political articles and websites and stuff. There should be fact checking websites dedicated to this stuff, where
financial.
You have an article like Barron saying presidential election years are bad for stocks, then it automatically goes to someone that has access to data of stocks going back to the market's inception, and they can run that quick and be like, wrong.
Yeah. Or they can run an analysis and say, you can do that if you cherry pick your data.
Right.
Yeah, because you can cherry pick, but then that's not real data.
It's insanity. Anyways, moving on to the financial planning topic of the week. This was a blog post on qualified charitable distributions, or QCDs, from Mike Piper at The Oblivious Investor. Taylor, who works in our office, has talked about qualified charitable distributions on the show before. But specifically today, Mike answered in his blog post some common questions that he gets from investors that I think are helpful to go over. So, and it is the season of giving, Nick, so I wanted to talk about QCDs. So first, let's just start for newer listeners by defining a QCD, or a qualified charitable distribution. A QCD is a way for people aged 70 and a half or older to donate to charity directly from their individual retirement accounts. You can send a check directly from your IRA to a qualified charity. The donated amount does not count as taxable income for you, and if you're required to take a required minimum distribution, or RMD, the QCD counts towards your RMD, which could help reduce your tax bill. So qualified charitable distribution yearly limits are set at $100,000 per person. So Mike says, sometimes I receive questions from people who are doing a qualified charitable distribution for the first time and something doesn't go the way they expected it. Most often, there's 3 comments. Number 1, the brokerage firm didn't report the distribution as a QCD. I just got a regular form 1099-R, which included the distribution. So the 1099-R is the tax form that you get at the end of each year showing how much you took out of your retirement accounts, right? So he says your brokerage firm does not report that distribution is a qualified charitable distribution because they don't know. The brokerage firm does not confirm whether the payee on the check is a qualified charity. So the brokerage firm is just going to send you a regular form 1099-R for the year that includes all of your distributions and QCDs. It is on the individual making the QCD to work with their accountant to make sure this is reflected accurately on their tax return. Number 2, the receipt from the charity did not confirm that the distribution was a QCD. Similarly, the charity is not going to confirm for you that the distribution is a QCD because, again, they also have no way of knowing that. So the charity is just going to send you a receipt that says something along the lines of, thank you for your donation of X amount of dollars. You did not receive any goods or services in exchange for this donation. So in short, again, it's up to you to know whether the distribution is a QCD and report it accordingly. Brokerage firm doesn't know, charity doesn't know, okay? Last but not least, the brokerage firm made the check out to the charity but sent it to me. And that's completely okay if the check is made out to the charity but delivered to you, and then you go ahead and forward it on to the charity. But it's not okay, okay for the check to be made out to you or for the funds to be electronically distributed from the IRA to your own account. In that case, it's not a QCD, it's just a normal distribution. So the money has to go directly from the IRA to the charity, right?
Yeah.
So it can't go from your IRA to your bank account to the charity. That's not how it works. So you can't actually take delivery of those funds and put them in your bank account and then send it to the charity from there.
And when you think of the complexity of all of that, that makes a ton of sense. Right?
Yeah, exactly. So there's no way for these financial firms to know what's a QCD and what's not a QCD. So it is up to you. Even if you do your own taxes and utilize a service such as TurboTax, there is an area for you to delineate that. And as long as you have the proof for that, in case you ever were to get audited, then it's not a big deal.
Yep,
so
absolutely.
Anything else, Nick, that you wanted to share with listeners before we leave it there for the week?
No. Happy holidays and safe travels to everyone out there over the next couple of weeks as you're driving around. We've had some wintry mix here in Dayton, so drive safe and enjoy time with family and friends.
Yeah, well said. Well said. Well, thanks everyone for tuning in to episode 280 of the Independent Advisors Podcast. We will be back with you next week for episode number 281.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.